Happy Saturday, World Wide Web. Welcome back to my stock channel. Another stock update on Credit Suisse, CS. Um, it's that big bank in Switzerland that got bailed out 3 months ago. Yes, it is. It's still floating around 90 cents a share. It's been in the low 80 cents a shares, and it's been bouncing around for a little while here. It's coming back up, though. There's an important reason I wanted to talk about this one because it's going to do really well, and I wanted to share that with everybody and explain why. Um, the government of Switzerland and HB Bank saved this company, or they call it saving. I'm sure they pillaged it quite a bit. They told all of their bondholders, their debt holders, they gave them the middle finger, told them all to get lost. So now you have a company with essentially no debt or very little debt. So most of their debt is gone. What they're left with is a bunch of loans that they get to collect on every month for the next 30 years. They're also probably left with a small amount of cash, not much depositor money. More people are sucking it out. Some people are probably sticking it in. It's going to come to a balance eventually. I wouldn't expect them to have wicked capital, and I don't expect these to be good times to be making new loans. Um, I don't know how bad they want to make new loans. I think they're probably going to spend the next 10 years collecting the old loans. On a balance sheet, this is going to look fantastic. It's going to look like a whole bunch of money coming in or whatever is coming in, and it has no cost factor on it. They don't have to pay back any of their debt. That's hugely important. Earnings report comes out June 27th. The world will get a first peek at what is the new Credit Suisse. We have no idea what it's going to look like. We can make some predictions, though, and those predictions have been made by stock analysts. 24 of them have done the head to toe on this company. They said it's going to be a $4 stock within a year. $4.40 was the average prediction. And the reason for that prediction is simple. They know what the bank is left with so far as loans. They know that it doesn't have any debt. And they also know that it probably just got robbed of all of its money and that there is a bleed on depositors. But they still have a lot of depositors and they still have a lot of loans to collect. And let me show you where it's been with the debt issue. And I find that the most compelling argument for why this thing's going up is the fact that the government of Switzerland gave the finger to everybody they owe money to. Balance sheet, here we go. They were looking at, in March of 2023, $486 billion in liabilities, $540 billion in assets. I'm sure these have been raided, but the locations are still there. The buildings they own and stuff is probably still intact and still a part of it. The core of Credit Suisse is still here. Any surplus of assets probably went to go pay off their crap for the bailout. I'd imagine this asset line got raided heavily. It wouldn't shock me to see this with less than 100 billion in assets or some number like that. The liabilities line, 540, that's going to come down, the assets to 100, let's just say 100 billion. Let's just say they raided the hell out of this company and the liabilities 486. I'm not going to say most of that's been canceled. I just know that all of their debt has been erased. It's kind of like they did a bankruptcy and came out of it. That's how you got to kind of look at it. And the judge told all of their bondholders, all of their debt, gave them the finger. They've fully paid back bailout money from Switzerland already. When they did that, I have no idea. If it's this quarter, it might look like a train wreck this quarter. The going forward projection, once the train wreck is over, and apparently they already paid it back, so the train wreck is over as of today. They've already paid back Switzerland. They're a freewheeling company. This is going to be the first earnings report. Yes, it might include some crap on it, but the forward projection on this company is going to be a profitable one. They're going to say, yeah, we're smaller, we're leaner, we have almost no bills. Overhead is much lower. We laid a bunch of people off, and we still have 30 years worth of these loans to collect, and we're going to do great for a very long time. And we still have, 80 million in depositor money or whatever it is, 80 billion. God knows how much it is. I guess none of these numbers matter. The ones that matter are the balance sheet, or I'm sorry, the income statement. How much money does this company earn? And it gets really strange. In March of 2023, you see a massive injection of revenue. I think this is some bailout money that they got. They got about 100 billion or no, 80 billion, but then they gave it all back almost immediately. They gave 60 billion of it back, and then they paid back the rest. This line and this line are just going to be nonsensical, coming down, going nowhere. This is not real net income, and that's not real revenue. That's bailout time right there. But these lines won't be projected on the next quarter, or maybe a small fraction of them will be. But the quarters going forward from that are going to be positive net income, and the reason is because they're not going to have any debt. Everything that comes in is going to be gross profit practically, minus their staff and the building cost. I don't think they're going to be burdened with debt. I think the least they can do when they bail out this company is leave it in a healthy state. And I'm pretty sure that's the deal that HBC made with Switzerland when they bailed this thing out, along with the help of Switzerland, is they agreed to leave it in a prettier place than it was when they did it, when they bailed it out. You don't bail something out with that kind of sponsorship and have them pay back all of the debt this quickly, and then turn around and leave them in a crappy spot on a balance sheet. When you bail somebody out, you're going to do it. You're going to leave a little profitable lemonade stand behind, and I think that's what they're probably going to show the world either this quarter, and if they don't do it this quarter, they're going to fully explain that it's going to be next quarter. So this stock's going to receive the benefits of an upward launch on forward projections just from the obvious. Look, we don't have any debt anymore. They've already paid everything back to Switzerland. It's all positive earnings from here. We're a smaller company now. We're a smaller bank. We still have a lot of depositor money. It could have been balanced out by now. I'm sure the people raiding the bank and withdrawing their money out is probably slowed. It probably slows more every day and eventually comes to balance with new depositor money. Yeah, so there's my analysis on this one. 24 experts have analyzed all of the rents and all of the revenues and all of the loans that they're left with and all of their monthly payments, and come to the conclusion that it's $4.40 per year. So how do you play this? That's the next analysis. Let's just pretend that it's going to be a $3 or $4 stock in a year. What do you do with it? It's 90 cents a share right now. Do you buy it for 90 cents and hold on to it for a year until it goes to $3? Well, that's one way to do it. I also want you to take a look at the January options for Credit Suisse. January options are 3 quarters away, 3 earnings away, 3 brand new earnings away. One is June 20th. The next one would be July, August, September, and then December will be the next 3 earnings reports. They're all going to be reflecting this great news that is supposed to pump this stock up to $4.40. You can go along for that ride with an option, and you can make a fortune, because the January 90-cent strike, right where it is today, you're already in the money, is only 12 cents. For 12 cents, you can control 1 share of Credit Suisse at 90 cents a share until January. As it goes up from 90 cents, you're in the money all the way. So you should be making at least half a cent for every cent it goes up until it gets to $2, and then you probably make 1 cent for every 1 cent it goes up after that, times 100. You'll get one contract for $12, and that's 100 shares that you control of Credit Suisse. You control 100 shares of Credit Suisse for $12 till January, and at that point, if it's worth $3, you should have, God, I don't know, from 12 cents to, that's got to be worth, from 12 cents to $2 would be the option increase, most likely. You'd be looking at a $2.90 option, and by the time December rolls around, you'll be able to sell that thing you bought for 12 cents or $12. You'll be able to sell that for probably $2 or $3 each. Could hit $3, could hit $1.50, but you're going to go 10 times to 20 times on your money if you do options. And if you buy it, just buy the shares outright, you might do 2 to 1, 3 to 1, 4 to 1. You might hit like that. But if you want a 20, 30, 40 to 1 opportunity, take a quick peek at the January options. The January $1.50 options, which means in January you can buy this thing for $1.50, are 3 cents right now. And actually, I just bought a ton of them for 2 cents each. The commissions were 65 cents a contract. So I bought like 70 contracts for January at $1.50. I think it cost me $132 to do that. But I control 7,000 shares for everything over $1.50 that they might reach. So if they reach for $3, I'm going to make $7,000 for my $132 investment. So, but I run the risk of it not hitting $1.50 by January. And you know what? If that wasn't going to work out, then the whole thing wasn't going to work out anyhow. I highly recommend the options. Do some research. Take a look at this company. Imagine it with half the debt it has, with half the overhead, with half the operating cost. Probably most of the loans still. I'm sure they took away the good stuff. It was fully pillaged. You can count on that in reality, but also in reality, they're going to leave the image of a pretty right side up company behind. This thing is going to be a positive balance sheet, or the promise of a positive balance sheet for next quarter. That's what we're going to hear at the earnings call on June 27th. There will be an interest rate increase possibly on June 15th, right before it. So you might have a little down point there. But grab these options. I grabbed them for 12 cents on Friday. I told my friend to grab them, and he had to pay 13 cents for them. So just this stock moved up 4.5% on the day. People are starting to dive into it. As you can see, this overperformed the Dow quite a bit on Friday, 4.54%. The Dow went up like 1%. It was a big day for the Dow, but it was like a 1.5% day, not a 4.5% day. So this one's already overperforming. Will it go down with the Dow a little bit? It might. But is everyone going to flock in with heavy interest to see this earnings report, to see what a company with no debt looks like on paper, to see what a company that just already paid off Switzerland completely? The HB Bank is supposed to leave in a good place. We're going to see that good place, hopefully June 27th. And if we don't see the good place, they're going to be promising the good place, which will be just as good. Once they say that we're in the black, this thing's going straight to $2-3. Once we start showing black, I'm hoping within 3 quarters, that's why I chose January, $3-4 stock. We're coming right back to where we were before. They're going to leave a tiny little healthy bank behind, and that's what it's going to be. So it's going to have 10 years of earnings baked in the cake. All those loans they still get to collect on, and they gave everyone the finger. It's capitalism in reverse, but it's a fantastic options opportunity or a good underlying stock opportunity just to buy it, just to see what the earnings do. You don't have to buy that much of it, but if you do options, you're in so much cheaper. I'm James. I hope you liked the video. I hope I made a decent argument for Credit Suisse. If it goes down, I'm sorry. I don't know. Can't imagine how with no debt that they go down. It doesn't even matter what their revenue line says. It's going to be bigger than the debt line by far, and it's only uphill from here. It's pretty much where it's settled at right here. You didn't miss out on anything. You maybe missed out on it being 80 cents for a little while, 84 cents, 85 cents, but you're still in the money on this one. But people are swooning in all the way through June, and then it's going to shoot up after June 27th, and then it's going to shoot up in September, and then it's going to shoot up even harder in December, and you could be sitting on that January option licking your lips the whole time for 12 cents a contract. It's shocking. People aren't looking at this the right way. A bunch of analysts are, but I don't know. Opportunity knocks, and for $132, you control at $1.50 a share this company, 7,000 shares. It's freaking shocking to turn 132 into 7 grand maybe, and maybe into 10 grand or 14 grand. God forbid I had some balls and bought a bigger chunk of it, but I did buy a bigger chunk of it, but I did it with the 90-cent option. I want to go all the way with it, but I was able to buy less because it cost 12 whopping cents instead of 2 cents. The $1.50s are only 2 cents. So either way, take on your option screen, click all, so you're viewing all the options for January 2024. I think you'll see the opportunity and you'll see what I'm talking about, and go look at the analyst expectations for this company, this new bank. I'm starting to feel like, and they can't fail twice. You know, they already got bailed out. It's not like you have to worry about this one failing tomorrow. That's the neat thing about this. I know that you're scared of banks, and so am I. But this one's already failed, so you can't fail twice. And they have $100 billion credit line with Switzerland. So yeah, they're in a good place. Expect good things, take advantage of it, jump on it. I want to see those options going up on Monday. I know you guys are going to fly into this one. I hope you do. Spend a small amount. I think you'll be more than thrilled. And if you're a higher roller, shit, you could control 100,000 shares of this for a couple of grand. Just amazing, and such an amazing opportunity. And these things don't come knocking very often. I've done a lot of research in hundreds and hundreds and hundreds of stocks per month. Just looking at them, reading the backstory, reading where it's going, what space is it in, what are the expectations, a little street sense mixed in there, doing the best I can. But this one here, you can't take a company, especially a bank that's collecting that monthly payment every month, that has no debt. Everyone got told to screw off. When I say no debt, I expect they still have a little bit of debt, but it's going to be a lot better than better was before. If there were a $4 stock before, it's going to be like that, minus some of their cash, minus all of their debt. So, and the debt seemed to be right up with their assets. So you can imagine their monthly payments were ridiculous. Now they're much better. And don't worry about their lack of deposits, because they weren't going to make any loans anyhow for a very long time. Nobody's buying a house right now. Nobody's buying real estate. Nobody's wanting to pay the 7 and 8% that's going to be coming. So they got a couple of years to get their act together, pile up the cash, win the depositors back over, and I'm sure they'll make some choice loans when they get the opportunity, and they'll be a good bank again. And a lot more oversight in the future is always a good thing in this situation. Please like my video and subscribe to my channel. Thank you very much. I hope you like my Credit Suisse video. It's a good opportunity. Check it out. I'm James. Have a wonderful Saturday.